It's Friday and welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Big show on tap that will hit right at the core of everyone's favorite trade. That is AI. Docusign CEO Alan Tigerson is in the house post-earnings. I'm psyched to hear how Docusign plans to keep ChatGPT at bay. That thing is a beast. But before all that fun, the top story of the morning for me is this blockbuster $72 billion deal Netflix is making for Warner Brothers. Here are 6 things on my mind as I go through this one. No order of importance. First up, this is a terrible Friday. If you are Paramount, Comcast, Amazon, Disney, or Roku, really awful. Don't count out the Ellison billions and Trump connections over at Paramount. This Netflix WB deal is far from done. Hat tip Amazon founder Jeff Bezos for only spending $8.5 billion to buy MGM Studios in 2022. MGM does matter. Best believe Netflix subscription prices are going way up. Should this deal close, how could that not happen? The cultures of these two companies couldn't be more different. Legacy bloated media and Warner Brothers meets lean and mean Netflix. Warner Brothers employees from top to bottom best spruce up their resumes. On this point, Netflix calling out $2 billion to $3 billion in cost savings per year by year 3. That's a hell of a lot of cost savings. And score a win for often bumbling and stumbling investment bank Wells Fargo. It's one of the advisors to Netflix, not spotted in the lineup for investment banking fees, Goldman Sachs. Sorry, not sorry. That out of the way, let's get to my first power player interview for today, and I really am looking forward to this one. Docusign topped analyst estimates for the third quarter with just over $818 million in sales. The company's AI-powered intelligent agreement management now has 25,000 customers, despite direct competition from OpenAI's DocuGPT. But investors are still cautious on the stock at the open after DocuSign's guidance for the current quarter came in just shy of Wall Street's expectations. Alan Tigerson, Docusign CEO, is back on Opening Bid. Alan, good to see you as always. Do you know if Netflix used your technology to sign off on this deal?
I don't. I hope so.
That's all we can hope for. Well, Alan, good to see you here. The stock a little under pressure here in the early going. What did investors miss in that outlook of yours?
Well, we had a very strong quarter. We beat our guidance on top and bottom line, the upper end of the guidance. As you pointed out, we have some really strong early signs of progress in our intelligent agreement management suite with 25,000 customers on a new AI-enabled product. I don't think there are a lot of enterprise software companies that can say that. And our core business is holding up very well. So, look, it was a very strong quarter objectively, and we will just have to let the stock price do what it's going to do.
You're also having some success with early renewals. When a customer is coming to you now saying, hey, Alan and team, I want to renew my subscriptions for your service early, why are they doing this?
Yeah, it's very often driven by overconsumption. So customers who are consuming more envelopes, that's sort of the unit of measure for how many contracts you're sending with DocuSign, often want to renew early. And then can also lead into a discussion about our new products, because it's a natural evolution going from using us for sign to using us for a broader suite of agreement management solutions. And so we're seeing both just straight up e-sign upgrades as well as upgrades into our IM suite.
I know you've worked hard, Alan, in selling that AI story and vision to the street as it pertains to DocuSign. Within these early renewals, when you are talking to customers, what is the AI they are signing up for right now?
Yeah. So we provide AI assistance throughout the journey that an agreement traverses. But just to be very specific, we create a repository of all your agreements. So that's incredibly useful in a number of use cases. Let's take sales. If you're running a sales organization, you want to know which agreements are up for renewal and what should I renegotiate when I do engage with that customer. And that is exactly what customers are doing. So we mentioned ServiceTitan, for example. They're rolling us out across their sales teams to do exactly that, to basically improve their sales process, speed up renewals, make better contract decisions. And we can achieve both internal efficiency and get more out of the data that's embedded in agreements. And that story is replicated then in procurement and in HR and in consumer banking type applications.
Are you working closely with these companies building models like a ChatGPT or OpenAI, Anthropic?
Well, we absolutely are. In fact, our first partner in sort of the current slate of LLMs was OpenAI. We run a lot of OpenAI models on top of Azure, and as you know, we announced last month a partnership with them where we're building Docusign directly into ChatGPT so that you can pull up agreement data and execute agreements directly from a ChatGPT interface. And we're now seeing inbound from all the other LLM providers, the Googles and Anthropics of the world, wanting to replicate that. We have a unique and proprietary position as by far the largest provider of agreement workflows and agreement data. And that happens to be data that's exactly what companies generally want to expose in these types of chat experiences. And so I think we're in a very, very strong position there. And of course, it's always been our philosophy. We want to make the customer's data available to them wherever they want to do it. If they want to do it in Docusign, great. If they want to do it in Salesforce or SAP or Workday, they can do that. And now in OpenAI, Gemini, Anthropic, and others.
If OpenAI is using your technology and there's an integration happening there, were you surprised when they came out recently? What was it, DocuGPT?
No, look, all platform companies need to illustrate to customers what you can do with the technology. And so they released a bunch of videos of things they've done internally. And one of them was a contract review extraction tool that I think their finance team had built. Those are not external products. Those are basically visualizations of what's possible with the platform. They should absolutely be doing that. And I think everybody's looking at contracts as one of the last frontiers. It's basically been unstructured data that wasn't accessible, and now with LLMs you can access it. But there's so much more to delivering an agreement management solution for enterprises. We integrate hundreds of millions of dollars of private consented agreements that companies give to us. That increases dramatically the accuracy of the models and the extractions compared to just use public data. We're in all the agreement workflows, so that gives us more context. And then we are the most trusted brand in software in the U.S. for the last 2 years running, as voted by Newsweek. So I think we are in a good position to benefit from all the great work that OpenAI and others are doing on the LLM front, and then layering our special and proprietary sauce on top.
As you know, Alan, of course, the stock did get hit when they came out, OpenAI came out with that new technology. Next year, what are you working on that will keep a company like that and all its funding at bay?
Yeah. I don't think we're going to be competing with OpenAI. It's hard for me to imagine that agreement management will be on the top 5 list for them. But you always want to think about competition. Docusign is in such a strong position we were the first mover in identifying this broader opportunity in agreement management and what AI could unlock. And we have built out this really broad suite now. And now in the next phase, I think the two things that we're going to do is we're going to take that suite and really tune it for individual functions, so sales, procurement, HR, and so on. And then you'll see that next spring. And then really add more and more enterprise features to enable large companies to deal with all the complexity and regulatory issues that they have internally related to agreements. And I think that's going to be a very powerful position, enable us to create this whole new category of software that we've laid claim to. So I'm very bullish. We saw some nice early enterprise wins here in the last couple of quarters, and so we're on our way. Coupled with our strength in commercial, I think we're very well positioned.
A lot of leaders, Alan, are weighing in on Gemini 3. Someone you and I both know, Mark Benioff, CEO of Salesforce, came out very bullish on Gemini 3. The difference is with a lot of those leaders weighing in, they didn't work at Google like you did. You spent over 11 years there. What do you think about Gemini 3? And is Google back, and were they ever lost to begin with?
I mean, Google always had tremendous IP. It was a question of whether they could express it fully in their products and get aligned. And I'm very impressed with the turnaround. You can really see Google has its mojo back now. Gemini is an excellent product, and I think it's going to be a very, very competitive space. And we of course want to take advantage of all the top models. And so I'm thrilled for my former colleagues that they're doing well. But look, it's going to be very, very competitive in the frontier model space, and you can see people carving out different positions. But Google has an enormous advantage from a data and model perspective, distribution, and they're all layers in the stack. So I think they're well positioned.
Do you think there will eventually just be one winner?
No, and I think you can already see that there is some specialization. Anthropic's doing a really nice job in tuning their offering specifically for enterprises. I mean, OpenAI obviously has created the category and is innovating very rapidly, and they're a hugely important partner for us. And then you've got players coming in that weren't even in the map a couple of years ago. So it's very, very dynamic. I don't think it's winner takes all. I think you'll see some specialization. There's even some culture and vibe aspects of the models that are different, and people have different preferences for that. So,
how do you see them as different?
Some models are perhaps more terse and very sort of precise. Others are more empathetic. Some models are tuned better for workflows like coding. Other models might do better with images and video. So there are a lot of different subtleties. I don't think it's one model to rule them all. And of course, in the agreement space, we look at all of them and we constantly test them against each other, and we have quite a bit of proprietary sauce and knowledge of how agreements are structured and the level of precision that you have. I referred to our data advantage earlier. You've got to train on actual customer agreements. We can see up to 15% improvement in accuracy when you train on private data versus public data. So it's not just about the models, it's about the data, and it's about the workflow that you're expressing.
Do you view these, where do you fall in this debate, Alan? Do you view these models at this point in their lifespan as simply commodities?
No, I think that's too strong. I think there's a tremendous amount of innovation. Commodities don't tend to have this level of pacing and evolution and innovation. So no, but I do think it is getting a lot more competitive, and the prospect of one company just owning all of it, I think, is far less likely, if it ever was, now than 2 years ago.
Docusign CEO Alan Tigeson, always good to see you. Happy holidays. We'll talk to you soon.
Thank you, Brian. Great to see you.
Coming up, we'll get the opening bid roundtable up and running. The topic, the future of Netflix as it looks to digest legacy media player Warner Brothers. We'll be right back. Welcome back to Opening Bid. I'm Executive Editor Brian Sozzi, and today we are going all in on the Netflix Warner Brothers deal. With me, senior reporters Ali Cannell and Brooke De Palma. Ali, I will go over to you. You got the story on the Yahoo Finance homepage. Does this get closed? I mean, I have so many thoughts on this.
There's a lot of questions. That's definitely the next TBD, right? The regulatory overhang, because during the whole negotiation process, a lot of Wall Street analysts were looking to Paramount Skydance and saying that that company would win out, partly due to the fact that the regulatory path forward looked more established than both Comcast and Netflix. You already had David Ellison friendly with the current administration. He was able to get that deal done between Paramount Global and Skydance Media. So there was an expectation that that would be positive for the negotiating table. However, now we have Netflix here. And I think one thing we were talking about with Citi analyst Jason Bazinet in the previous show was that the fact that Netflix is just going after a portion of the business, that could actually help them here. He doesn't see any problem with the studio side. What could be a problem is the streaming side of the business, because you have the biggest streamer in the world, Netflix, now getting even bigger. Although Netflix plans to keep HBO Max separate from the Netflix app, they are talking about bundling, creating more choice and optionality for consumers. So that's the argument that Netflix is going to make. It's just going to come down to whether regulators buy it or not. So I think there is certainly a good chance that it gets approved, but there's going to be several hurdles that this deal needs to pass along the way before we get to the finish line here.
Thought number 2 out of 75 for me, Ali. This could be a major cost-cutting exercise on the part of Netflix if it does close this deal. They're calling out, $2 billion to $3 billion in potential cost cuts by year 3. I mean, that's huge. And I think if Netflix were to get in there, they're going to find a lot more cost savings than that.
Yeah, and I think that's something that can be a positive for investors moving forward. Obviously, the stock is down right now. There's much uncertainty out there when it comes to this deal. It's really big, it's expensive, it's complicated. Netflix has never been intertwined with a legacy media company before. It's also never been a big buyer of any type of asset. It's more of a builder here. The company did say on its third quarter earnings calls that they would be making strategic acquisitions that make sense, but this is by far the biggest acquisition that they've ever attacked, and it really seemed to come out of nowhere. It was a bit of a surprise for Wall Street, and then we were just talking about the TBD factor on the regulatory front, all of that uncertainty contributing to the price decline today. But it certainly brings a lot of key franchises to the company. You have The Sopranos, you have Friends, you have Game of Thrones. That's all going to now be under the Netflix umbrella. It also gives them a lot of exposure when it comes to global content, and that is key for all of these streaming platforms. And also it prevents their competitors, Comcast, Paramount included there, to not have access to this content. So it really just widens the gap here between the winner, which is Netflix, and those that are trying to catch up.
Brooke, as you know, we don't recommend stocks here at Yahoo Finance, but I could soundly recommend this. If this deal closes, it's going to cost more for Netflix every month. I mean, when Netflix is spending $72 billion to buy this asset, and I best believe there is some assumption in some slide deck that it's going to cost double to get Netflix.
And leading into this announcement today, we've heard from different analysts across the street about just the opportunity, about the ability for Netflix to raise prices. We had a note from B of A earlier this week that said that Netflix has air cover to raise prices given low price sensitivity, especially considering competitors' price increases. Like think of Hulu and Disney, which both have raised prices so far this year. And as Ali mentioned, the type of opportunities and the type of bundles that could come out of this. I mean, we're already seeing this. We see Hulu, Disney Plus, and ESPN come in a bundle, even Verizon offering a bundle with an increased plan. And so it'll be interesting to see the way this plays out. Could we have more people as they opt towards the ad tier Netflix? Could they now sort of get HBO Max in addition to that? And would they be willing to pay up for that? And I think this really puts Netflix, if this deal closes, in a sweet spot where they would be, if not already are, the really streaming service giants. And just to think about how this company has evolved over the past decade, over the past 15 years to come to this exact moment this morning is definitely monumental, definitely a change in streaming history for sure.
Ali, I could just see the release already from Netflix. Due to the increased value we're offering, you're getting more stuff. We're going to double your price. And let me tell Netflix, I'm going to cancel if it goes over $50. But Ali, you know, this also probably isn't a good day for Disney. And there was reports over the past 2 weeks we might get that Bob Iger successor right out of the block next year. Theoretically, they could be spending their first year on the job, whoever that successor is, trying to thwart this deal or trying to think about how they compete against this new behemoth.
Yeah, and it was interesting because Disney never put its hat in the ring here. They sort of backed away and said, I'm not interested in WBD. So it really was a game between Netflix, Comcast, and Paramount in the end. But Disney certainly has its work cut out for that company, especially with the new CEO, whoever that will be. Obviously, any type of leadership transition is tough. But for a company like Disney, huge conglomerate, has so many different facets of the business. We know what happened last time, that leadership transition with Bob Chapek didn't go according to plan. Disney has this really complex plan in place to make sure there's no repeat of that Bob Chapek disaster. But there is obviously going to be some growing pains whoever enters into this new role. So I think the CEO transition is going to be crucial for Disney. But in terms of their streaming access, I mean, Hulu does really well. Disney Plus, in addition to that, they're comboing those two streaming platforms together to have sort of one more unified platform. And across the street, analysts sort of view Disney next after Netflix. So it's sort of Disney and Netflix at the top here, and then all of these other subscale streamers that are looking to catch up. So I think because of that, you're going to see even more consolidation in this space. Perhaps maybe Paramount Plus combos with Peacock. Who knows? Like, there are just so many different types of avenues that these companies could take, especially when it comes to the future of streaming and media at large.
Ali, where is Bob Chapek? He's just out on an island somewhere? I haven't heard from this guy at all.
I hope he's on an island with his beard. I hope he kept the beard.
With his beard
and
and
that he's just chilling.
And his millions. I want to make a hard right turn and
Yes.
give you something, Brooke, in your wheelhouse, and even my wheelhouse too. I've really been thinking a lot about dollar stores. This has been a tremendous week for Dollar General and Dollar Tree, the main two dollar stores in this country, operating thousands of stores. Big sales gains, earnings calls where the executives are saying we're getting new households, people earning $100,000 or more are coming to dollar stores for the first time. And I was just blown away by some of this commentary.
Brian, both Dollar Tree and Dollar General still enjoying a pop as we make our way towards the end of the week, both up more than 2% even today in this morning's trading session alone. And these companies are up more than 50% year to date, far surpassing the S&P 500's 17% gain, even above 60% year to date as far as their stock price has seen soar. Exactly what you said, high income shoppers are turning to these dollar stores. They're looking for value. They're looking for the best bang for their buck. But importantly, they're also looking for the multi-price strategy that both of these retailers have really been putting in the work to identify. They're spending more when they go as well. The average ticket size at both of these companies is higher because of the fact that people are just buying more. They're turning to these dollar stores more frequently as well, especially maybe more so Dollar General as they really expand their offerings. And then because they've been doing so well, now we heard from Dollar General that they're opening more than 450 stores. They're remodeling 4,000 stores. And on top of that, too, they plan to relocate around 20 stores. And so clearly they're in this sweet spot in this environment where consumers are continuing to go to them. And clearly they're able to reinvest in the company to keep up with that momentum in hopes that that will continue into next year.
I just wish both of them sold more fresh fruit and vegetables. A lot of frozen food down that aisle. Good to see you both. Alec Canal, Brooke DePalma. Appreciate it. Have a great weekend. Coming up, Julie Hyman has you covered on Market Catalyst. I'll return at 10:15 a.m., which is very soon, for a chat with AI play Rubrik. Stock is ripping higher following earnings last night. We'll be right back.